Once you save $2 million in your portfolio and you're over the age of 60, you really start thinking seriously about retirement. But just because those are nice round numbers doesn't guarantee you're financially ready quite yet. That's why in today's video, I'm going to show you what your options are if you're that 60-year-old with $2 million in your portfolio, wondering when you'll be able to retire. And to illustrate some of these points, we're going to pull back the cover and actually look at a real 60-year-old couple's financial plan. This is Joe and Jackie, and we're going to see what they can do as 60-year-olds with about $2 million in their portfolio, wondering how much they might be able to spend. So this is a real couple, and it's a common scenario that we plan for quite a bit, but I want to point out that whether you have $2 million in your portfolio, a lot more, a lot less, the principles we're going to walk through should apply to all of you. So make sure that you focus on the numbers, but more importantly, focus on the steps and the principles that we point out as we go through this. So this is Joe and Jackie, and as you can see here, they have some money in the bank. They have about $1.8 million or so in investment, so just under a couple $1 million, and that's broken down between HSAs, brokerage accounts at Vanguard, Roth IRA at Vanguard, 401ks, IRAs. They have a few different accounts in multiple different places, but getting close to about $2 million in their portfolio. In terms of property, they own their home outright, and they also have a townhome, and the combined value here is about $585,000. So these are their assets, total net worth of about $2.4 million. In their goals are they want to retire. So both of them are 59 years old today. And as you can see, Joe wants to be able to retire in December of 2025, and Jackie recently retired already. So she's done working, Joe will continue working, and he wants to continue working about another year. When they do retire, their retirement expenses are $8,000 per month. So these expenses isn't everything. I mean, this doesn't include property taxes. This doesn't include any homeowner's insurance. This is just core expenses: food, electricity, entertainment, things that they want to do on a monthly basis. They factored in an average annual healthcare cost of another $6,000 per year for each of them. So called an extra $1,000 per month on top of the $8,000 per month we're looking at here. And then we're also factoring in long-term care. Now, this long-term care, I'm going to come back to this because this is in no way an indication or, of course, a guarantee that there will be long-term care expenses, but it's an estimate to say if there are long-term care expenses, and if we're assuming that both of them will have these expenses for the last 2 years of their life, what we're looking at is today the in-home care, the national average of what it costs for in-home care, and then we're inflating these numbers actually by 5%. All medical expenses in these projections we inflate at 5% just because medical expenses have increased faster than the overall rate of inflation. So keep that in mind, that this is certainly one of those expenses that we hope doesn't exist, but something that we're going to plan for. Beyond that, there's a vacation goal. So when they do retire, they want to be able to spend an additional $25,000 per year for the first 11, 12 years or so of retirement. So this $25,000 per year is in addition to the $8,000 per month. So these are their goals. Joe is earning right now $225,000 per year. So a healthy income, that's allowing them to save. Jackie's salary is no more, but they do have Joe's salary for about another year. And then when they retire, they'll have Social Security. So Joe's Social Security benefit at age 67 will be $38.69 a month. If Jackie collects her benefit at 67, her benefit will be $2,700 per month. So one of the planning points here, of course, is if they're retired at 60, but Social Security doesn't kick in until 67, what does that mean in terms of what their portfolio needs to do in those gap years to fill all of their retirement expenses versus what does their portfolio need to do from age 67 and beyond? So that's going to be a very important planning point that we're going to look at in just a second here. So for the next year or so, while they are working, Jackie's 401k contribution is now gone since she's no longer working, she's retired. Joe is saving $84,000 per year of his salary to a taxable account, and then he also has his HSA. So that's the savings between now and retirement. And what we have a picture of now is a snapshot in time of what they have today in assets. 401ks, Roth IRAs, just retirement assets in general. What they have in home, what they have in cash. We have a snapshot of where they are today. We then took a look at what are their goals for the next 30 plus years. What do they want to spend? What will health insurance cost? What about travel? We have a sense of what the target is. We know what income is, both today in terms of salary and Social Security in the future. And we know what they'll be able to save for the next 12 months or so. Now what we want to look at is what are they on track for? Are they on track to be able to fund all of this? Now, if you've watched any of these case study videos before, you know this is always where we go first. This takes us to the retirement cash flows. The lifeblood of any successful retirement plan is understanding what income will be coming in and how does that compare to the expenses going in. So what we can see is income coming in for 2025 is going to be sufficient to meet their needs. Joe has his salary. That's going to cover what they need to cover in terms of their expenses, taxes, etc. they're good for 2025. Retirement planning is less concerned about can we meet our needs when we're working and have income to do so. It's much more concerned about or much more focused on what about when that salary goes away. And you can see what this is taken into account is if he does retire in December of 2025, that's 11 months of the year. So that's why it's not the full 225 that we looked at in his income before. But once that salary goes away, there's nothing coming in salary. They will have Social Security, but before Social Security kicks in, they have 1, 2, 3, 4, 5, 6 full years of no income coming in until Social Security comes in to help support some of their living expenses. Once Social Security does kick in, you can see what that benefit will look like the first year when they both start collecting partway through the year. So they get a very prorated amount and then their full benefits starting the following year. And then here's what that combined income looks like. Now, as I'm starting to go through this, make sure you subscribe because I often go through these case study videos where I walk through how can you plan your own retirement, walking through real individuals' plans. So if you haven't already done so, make sure that you subscribe. So as we continue on here, here's our income flows. Plan distributions, this is projected distributions from the health savings account. Now, you could take this sooner, you could take this later. What we're illustrating is what if they begin taking their health savings account distributions once they reach Medicare age. Here's what that might look like in terms of how it compares to their medical expenses at that time. So with the HSA, we're going to treat that like an income source right now because that's coming in to meet some of their actual expenses. So when we look at all of this, we can see here's their total income. You see total inflows in this column right here. And what we want to compare that to is what their total expenses will be. So if we start the first full year of retirement, here's those expenses. This is the $8,000 per month, which is $96,000 per year, but we have to factor in inflation. So this is inflation taking this cost 3% higher every single year. Then above that, like we mentioned, they still have property taxes, they still have homeowners insurance, they still have some maintenance. We're planning for that separately. So there's an additional $1,000+ per month, $13,000 per year that we're factoring in for housing. So we look at living expenses of $8,000 plus housing of another $1,000. Then they have healthcare expenses beyond that. And then they also have their property, their vacation home that has its expenses as well in terms of insurance and maintenance. So as we start to add everything up, we get a sense for what will the total expenses be so that they can maintain their desired standard of living. But keep in mind, they also had a travel goal. They wanted to be able to spend $25,000 per year. Now, some people ask, well, why don't you just lump that in to their normal monthly expenses? Well, the reason we like to separate things out is you can see this travel goal doesn't last forever. So if we said, okay, $25,000, might as well just round that to $2,000 per month. We could lump that into the core expenses of $8,000 per month. But then this assumption or this planning projection would assume that that was an expense forever. For many people, they're not going to be traveling forever. They want to take most of their trips earlier in retirement, and by separating it out, we can really get more precise with how long does this expense need to be planned for before, as you can see here in 2038, we're no longer planning for this expense in their plan. Same thing with health insurance. Health insurance might change between pre-Medicare and post-Medicare. We might want to inflate health insurance at 5% per year, whereas we inflate normal expenses at 3% per year. So this is why we break things down in this way. And then finally, we want to look at projected taxes. If this is what they want to live on, they want to be able to live on that amount after taxes have already been paid. So if we take an arbitrary year here, let's take age 64, this is how much they would need to have coming from their portfolio so that they could pay taxes, they could pay for travel, they could pay for their rental home, health insurance, housing, and then end up with the equivalent of $8,000 per month to support all their other basic living expenses. So this net flows here is an important place to focus on because what you'll see here is this number is not going to stay constant. It's not going to stay constant, one, because over time inflation goes up, which means they need to pull more and more from their portfolio. But then there's other forces at play. Like what about when Social Security kicks in? What you see here is, yes, their withdrawals from their portfolio increase the first few years, but then they drop. They don't drop because they stop spending as much. These withdrawals drop because now they're taking less from their portfolio, knowing that more is coming from Social Security. But these are really important numbers to know because what we can do is we can start to say, knowing what we're projecting that you're going to have to pull out of your portfolio each year in retirement, how does that number compare to what your projected portfolio value might look like? That's where we get the concept of a withdrawal rate. A withdrawal rate says what's the percentage that you're pulling out of your portfolio each year. And that's a really important thing to know. If you almost think of this as like KPIs or a dashboard of things that we want to keep an eye on, the withdrawal rate is certainly one of those things. The withdrawal rate tells us, are we taking out a sustainable amount from our portfolio, or are we taking out an amount that might cause our portfolio to be spent down too quickly? Now, what you can see here, 7%, 7%, 8.5%, 9.7, 10.3, these withdrawal rates are very much on the high side. Now, they do drop when Social Security kicks in, but they're still higher than I personally would feel comfortable with. If you look at withdrawal rates, there's a lot that they're dependent upon. How are you invested? How long do you need these withdrawals to support you for? Are there going to be changes to income or expenses in the future that are going to mitigate or change the amount that you're taking out of your portfolio? All of these things go into what's a sustainable withdrawal rate, but generally speaking, somewhere between, call it 4 and 5.5%, making some basic assumptions about your portfolio, is what we want to start with when it comes to looking at this as a withdrawal rate. So when I see this, and I see that it's 7% the first few years and growing, and when I see that this might be a prolonged period of time, that they're taking out more than I would consider a sustainable withdrawal rate, that gives me pause. That makes me say this probably isn't something that is reasonable to assume can be done right away. Now, if this was 7% the first couple of years and then it drops off dramatically because a mortgage is paid off, they drop their spending or Social Security kicks in or whatever it might be, that's one thing. But when this withdrawal rate stays higher, that gives us some concern, so much so that we look at what's the actual probability of success here. What's the probability of success that Joe and Jackie would have if he retires next December and all these assumptions are true? Only about 1 in 3 cases are they actually going to meet their needs. Say 1 in 3 cases because some of these assumptions are in their control, but many are not. The biggest one is market returns. Part of this is saying, look, if you get a really great market, a market environment that's, let's say, is in the 66th percentile, just to use these numbers here. So it's a really good market environment, the top third of all outcomes. Yeah, you might be able to make it. But we don't want to assume that that's going to happen. We don't want to base your retirement success on getting something that's above average rates of return. We'd like this number to be a lot higher because even when we look at this on paper, looks like Joe and Jackie, yeah, here's your assets. Here you are today. By the time you retire, there's a couple $1 million in your portfolio. You're 60. You are projected to have that money last for you. Why this big drop off at the end? Well, this is where long-term care kicks in, which is a planning point that I want to walk through with everyone. You're projected to make it here, but this is assuming you get the same growth rate every single year. This is assuming you get about a 6.5% growth rate every single year in retirement. And I can tell you with certainty, you're not going to get that every single year. You may average that. You may even average above that. But the sequence in which you receive those returns is really important, and that's why we also measure probability of success. So what can we do here? Well, what we can do is we can start exploring alternative options. What if they work longer? What if they save more? What if they cut expenses? What if we look at some different scenarios? Because the goal here is to say, how can we make this work? The goal is just not to say, hey, you can't do this, better luck next time. The goal is to come up with a solution or multiple solutions, ideally. So as we go through this, keep this in mind. A lot of people reach out and ask, hey, where can we get this software? Can we follow along with you? Any client that's at Root Financial, we of course go through this with, but even if you're watching this and just want access to the software, you can get access to a version in the Retirement Planning Academy that's in the link below. So keep that in mind if you want to run some of your projections as we go through this together. So let's take a look at some of these what ifs. Now, one big what if is what if there's no long-term care cost? Not something that you can control, not something that you can even know ahead of time, but it's at least helpful to understand how would that impact things. Assume there was no long-term care cost. What does the new projection look like? Well, as you can see, it kind of smooths things out here. In terms of probability of success, it doesn't get things to where we'd want them to be, but just helpful context to know that, look, something that's entirely out of our control, but that what we have to plan for can have a pretty dramatic swing in terms of your overall success or lack of success with your plan. Now, we can't assume that that's going to happen. So let's reset that for the time being. Let's assume that there is long-term care costs. We do need to understand, well, what could you do to mitigate that? One thing that you could look to do is this just assumes that, look, your portfolio assets start to decline, but what it doesn't take into account is their overall net worth. Their overall net worth might still be $1.5 million even after some of these long-term care costs because they have 2 properties. So net worth doesn't do you much good if it's all on a property because you can't spend your property. Unless you sell it, unless you refinance it or take out a loan against it, you can't really sell an illiquid asset, or you can't really spend, I should say, an illiquid asset. But this is helpful to point out to say, look, it's not as if you don't have assets at this time. It's just that most of them are tied up. So if we go back to this graph to say only about 100,000 or so would actually be liquid, well, what if you did sell your home? What if you did have long-term care costs and you sold this home, let's say 2053, the last couple years. What if you sold the townhome same time, 2053? What would that do? Was that something that could potentially mitigate some of the impacts of long-term care? And what we see is the answer is yes. Now, maybe not fully, but probability of success starts to increase. So that's just something to be aware of on the front end, is start to understand what options do you have to meet some of these unknowable, unpredictable expenses that may come in. So right off the bat, we can start to see, okay, there's at least some fallback. There's something that we can look at here to potentially offset some costs. But let me go back to what if they never sell either of these? They keep both properties, they don't liquidate them. Well, with this here, I would not feel comfortable telling Joe and Jackie that, hey, you can retire with only a 33% probability of success and a portfolio trajectory that's not looking like what we'd want it to look like. So what can they do? Well, we can start playing with what if they work longer. Now, Jackie's already retired, so I'm going to look at what if Joe worked one extra year here, just to plug in some numbers. One extra year, what does that do? Pretty significant impact. Probability of success jumps pretty significantly there. Still not to where we'd want it to be, but that's a pretty significant jump. What if they work 2 extra years? Or what if Joe works 2 extra years, I should say here? As we refresh this and see the impact there, it starts to have some profound differences. The probability of success starts to jump up and gets much closer to where we'd want to see that. Why is that? Why does one single year of work? They work all the way, I don't know when they started working, but let's say from age 22 to 60. And that got them 34% of the way there in terms of the probability of success. But 1 extra year, 2 extra years effectively doubles the probability of success. Why is that? Well, a big part of it is this. If we go back to cash flows and we start to look at this, keep in mind that the current plan we started with, the starting point when we look here, the biggest withdrawals they're taking from their portfolio are in those early years before Social Security kicks in. So if we could mitigate those biggest withdrawals, and in fact, if instead of withdrawing from our portfolio for 1 more year or 2 more years, we can actually continue growing our portfolio for 1 more year or 2 more years, we can see how the proposed plan or the new solution, what does that do to cash flows? It reduces that pretty dramatically. What does that do to the withdrawal rate that we're looking at? Well, as we can see here, if we look at that withdrawal rate, it's now much lower. You can see there's no withdrawal rate these years. Yes, it's still higher than I like, but it then drops down to a more sustainable rate after just a few years. So don't underestimate the power of 1 additional year of work in those early years. When that's 1 more year of saving, 1 more year of portfolio growth, 1 fewer year of strain on your portfolio before Social Security kicks in, it can have a dramatic difference. So that is certainly one option, but it's not the only option. What I want to go back here is I might talk to Joe and Jackie. And I don't know, Joe's health might not be great. Jackie's health might not be great. They might be saying we need to retire because we're just so burned out. We're not sleeping. We're anxious. Where our health is deteriorating because of work. Let's assume that's the case. And we say, okay, it's not an option to work longer. What is an option? Well, what if you spent less in retirement? How would that change things? So if you still retire when you're planning on retiring and you cut $1,000 per month from your core monthly budget, that also has a pretty dramatic difference. As you can see here, probability of success starts to change. So when we look at this, we can start to say, okay, what is that number that makes more sense? Maybe in addition to taking $1,000 a month off of expenses, what if we also took some money off the monthly or the annual vacation goal? You know what if we actually just use a round number, took $10,000 off? What would that look like? And as you can start to see, some of retirement planning is just testing different things. Well, pretty dramatic changes here. Probability of success goes up quite substantially. So what you can start to see here and what we're building towards is we want to build options for Joe and Jackie. We want to understand that first and foremost, yes, retirement comes down to trade-offs, but if we jump right to that, we miss the first step. And that first step is that we need to understand what those trade-offs are. So what we can see so far is they could potentially sell their properties at the end of their lifetimes if there were long-term care costs, and that's going to get them closer to their ability to meet their goals. They could work longer, and working longer, maybe a couple years longer, is going to get them much closer to their goals. They could cut expenses. But here's something else. Ideally, you don't want to have to make changes. In a perfect world, could we make this work without having to work longer or cut expenses? Can we have our cake and eat it too? Now, impossible in reality to do both those things, but here's something that's important to note. This is where understanding how most retirees spend, understanding retirement strategy, understanding the retirement landscape really can be quite helpful. What if we went back to this and reset all of this? So let's go back to the base case. One of the things that we're assuming here is we're assuming that they take that $8,000 per month and they just adjust that for inflation. That's not how most retirees actually spend. There's something called the retirement spending smile. And all that is a bunch of research that says how do retirees actually spend their money? And what we see is that spending tends to start to taper off over time. You don't spend up here and then all of a sudden drop off at a certain age. But what does happen is you might spend $8,000 per month. But as inflation's increasing at 3% per year, in this example, your spending might only increase by 2% per year. Because you're not dramatically making changes to lifestyle year after year, but you're slowly starting to taper things down. So if we go to retirement spending and say, what would that look like if we adjusted retirement spending at 2% per year, while inflation grew at 3% per year? Well, that alone, so not working longer, not selling property, not having to assume that there's not going to be long-term care costs, just spending like the average retiree spends alone has a dramatic difference. That alone gets their probability of success way up. That, if you then combine it to say, well, what if you cut just a little bit off the monthly expenses? And what if maybe you did work one extra year? And again, this comes down to a very personal decision. Which of these options makes most sense? But when you implement a retirement spending, spend a little bit less, work one more year, all of a sudden, those seemingly small changes combine to make an incredibly dramatic difference. So going back to my point, yes, we all understand that things are about trade-offs, but understand what trade-offs exist. Understand how a combination of these trade-offs can take a plan that at first seemed like there was no chance to do this in a responsible way, and with some very minor adjustments, have an outcome that's dramatically different. So as we go through this, yes, these specific numbers are unique to Joe and to Jackie, but these principles of understanding what trade-offs you and understand that you can combine those trade-offs in doing different things to make your retirement work, this can be incredibly powerful. So have your projections, run your projections, make sure that you're looking at all this, because when you're approaching your retirement, it's oftentimes the little things or a combination of little things that makes all the difference. Root Financial has not provided any compensation for and has not influenced the content of any testimonials and endorsements shown. Any testimonials and endorsements shown have been invited, have been shared with each individual's permission, and are not necessarily representative of the experience of other clients. To our knowledge, no other conflicts of interest exist regarding these testimonials and endorsements. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.